Hello everyone, I want to share something about something I've spent a lot of time researching lately, how the One Big Beautiful Bill Act, or OBBBA, changes the way charitable donations work starting 2026. So like many of you, I donate to causes I care about, and I was concerned about how these changes affect the tax benefits of my giving. So I'm sharing my personal findings here and my own planning ideas. And I'm not giving professional advice because please remember, I'm not a tax professional, I'm not a CPA, I'm not a CFA or any financial advisors. I'm just an ordinary donor like you. And this is my own research sharing, or more like a discussion to encourage more discussions from you. So you must talk to your own tax advisor before your actual actions. So if I have any corrections to make, I would put it as a pinned comment, so be sure to check that out. And I am just an ordinary person like you. I could make mistakes. So if you see it, please point it out and everyone will thank you. So in this video, we are going to start with the basics of itemized deductions. Then we will dive into two major changes starting in 2026. The good news for non-itemizers and the challenges for itemizers. Finally, we will cover some strategies that I was thinking about for donors, like bunching and using a DAF, and what this all means for the charities that we support. So before 2026, getting a federal tax break for your charitable giving means you have to itemize deductions. You tally up your expenses, state taxes, mortgage interest, and your charitable gifts. And if that total is bigger than the big standard deduction, you itemize. For a brief temporary period during the pandemic, the Congress allowed an additional charitable deduction for cash donations, even if you are taking the standard deduction. That temporary break is now expired. But the OBBBA now gives a completely new set of rules. That is what we need to plan for now. So first, let's look at the good news for non-itemizers. If you are one of the millions of households that takes a standard deduction, then the OBBBA has created a charitable donation deduction starting 2026. You can deduct up to $1,000 for single filers or $2,000 for married couples filing jointly, while just taking the standard deduction. This is great incentive for everyday givers. So what's the catch? Well, it must be a cash donation made directly to a public charity, not any private foundations. So you cannot use this deduction for donating appreciated stocks or for contributions to a donor advised fund, okay, I'll say DAF. And we will talk about those two things shortly. So now, here is a challenge for itemizers, the new 0.5% AGI floor. If you are someone who itemized deductions, well, starting in 2026, you can only deduct the part of your charitable gifts that exceeds the 0.5% of your total AGI, or say adjusted gross income. So let's use an example. Let's say your AGI is $100,000. Then the floor is $500. If you donate $2,000, you will be able to deduct only $1,500. And if you donate only $400 throughout the year, then you get zero federal tax deduction. That first 0.5% portion is just permanently non-deductible and lost. This AGI floor makes giving small amounts of cash incredibly inefficient for itemizers. And to make it more complicated, there's also some kind of potential carry forward rule about this AGI floor. But I have read conflicting articles about the requirements, and many articles actually suggest that to get that carry forward, you have to meet a very, very high bar that is very hard for ordinary people to reach. So in this one, we are not going to dig into it and just assume that doesn't apply to us. And if you do reach that very, very high bar, which means you are donating a huge percentage of your money, well, do remember that there are still other caps that will be applied on how much you can deduct. But we won't cover it in this session, just to make things simple. All right, so given this, what could be our possible strategies to work with these new rules? Here are some of my personal thoughts. So strategy number one, as right now it's still end of 2025, and the new rule actually kicks in 2026. So you may still have the chance of the 2025 lump sum lock-in. So if you're an itemizer and you plan to give significantly over the next few years, 2025 is your final chance to make a large gift without the AGI floor. So to do this, you can accelerate your giving to make a large single contribution now to secure the full donation under the current better rules. And to maximize that gift, there are two tools that many people use, but also a lot of people are not aware of them. So number one, did you know you can donate appreciated stocks? So if you've held a stock for over a year and its value has soared over the time, and you can donate that shares directly. You can get the deductions for the full current market value, and you completely avoid paying that long-term capital gain tax on that profit. Essentially, you deduct more on tax, and the charity gets more in donations. And who gets less? Only the IRS. So this is one of the best tax saving moves in the code in terms of donations. And number two, sometimes you say, well, I don't want to donate that much money to that charitable this year. I want to do it over few years, right? That's totally fine because that's where we call donor advised funds come into play. A donor advised fund, or say DAF, is an account that is your charitable account. You can open it at many financial institutions. The key is that you are contributing a lump sum today, cash or stock, and you can get the immediate itemized tax deduction on the full amount. And the money can stay in the account, grow tax-free, and you can later grant it out to charities year after year. Doesn't have to be the same year. And another key benefit, many small charities, they actually don't have a setup to accept appreciated stocks as donations. But with a DAF, you can first donate your appreciated stocks to the DAF, that converts it into cash, and then you can then use the DAF to grant those cash grants to those small charities. So using cash, stock, or a DAF, you accelerate your giving in 2025, and then you grant them out to the chosen charities over time, and that's the strategy. So now, let's say you're already past 2025. Let's say it's already 2026 now, and you don't have that opportunity anymore. What can you do? Well, the same strategy still applies. It's just not as effective as 2025. So this is essentially called the bunching strategy. It's the same way. If you itemize and you're planning to make donations regularly, still the most efficient way is to only deduct every few years. This is called bunching. So you consolidate several years of worth of giving into one single large contribution, for example, to a DAF. And you make sure that amount is well above that 0.5% AGI floor. And you itemize on that year and take the full big deduction, minus the floor, of course, in that given year. This allows you to only be hit by that floor once every few years. So this strategy has been used by many people even before these new rules, but now the AGI floor has made it even more impactful. Okay, now scenario 3, not necessarily strategy 3 because it's really a dilemma for small donors. What if you are only making, let's say, 0.05% of your AGI as your donation every year? So if you take the standard deduction, well, great. Your best strategy is just to stick with cash donations and keep those receipts to claim that new $1,000, $2,000 deductions every year, starting in 2026. But if you are itemizing and because your annual giving is relatively small, even if you are trying using the bunching strategy, it doesn't reach that 0.5% AGI, that can be tricky. Basically, anything that you donate will not get a federal tax benefit. Another possibility, if you are going to itemize because you are living in a state with a high state income tax like California, one possibility is you can see if you can wait until the higher SALT cap expires in 2030. So during 2026 all the way until 2030, the SALT cap, which is basically how much you can itemize deduct on your state tax stuff, is temporarily raised to $40,000, and that will fall back to $10,000 when it expires. And that limit might force you back into taking the standard deductions. And if that's the case, then you can again start to donate in cash to claim that new $1,000, $2,000 deductions. So this is a very tricky situation, and it's really up to your own situation. So with all these strategic changes for donors, what does it actually mean for the charitables that we support? If you are a fundraiser, an executive director, or just simply involved with some nonprofit, you may want to be smart about these changes. So if you are a public nonprofit, you may want to start to raise awareness about the new 1,000, 2,000 cash donations for your massive audience that are taking standard deductions. Those people may have been held back because they were not able to get a donation deduction before, and now they actually can. And for your itemizing donors, you may want to help them do more planning. For example, if they were not aware, you can educate them about the possibility of the lump sum and the DAF strategies, especially now in 2025, to help them beat that new floor. You help them, it helps you. So as a conclusion, the OBBBA now is a done deal, and it truly reshapes the tax planning for charitable givings. And if you're an itemizer, 2025 could be a critical planning year for you. And if you are taking the standard deduction, well, you'll finally have a federal incentive to give. So I hope this overview of my research was helpful for your own planning. And let me know in the comments below about what you are planning to do, or whether you have other strategies that I haven't thought of, and everyone can benefit from your sharing. Thank you.